Good afternoon, everyone. Hope you're doing well. Elizabeth, confirm the count we are in at the moment, just for good order.
So people are still joining. I have about 15 attendees now.
All right. Great. I think in the interest of time, I will like to kick off the session. And to start us off, my name is Abraham Brono, Associate Director within KPMG East Africa Advisory Practice. And would like to welcome you all, a warm welcome from KPMG this afternoon session. Title, Stay Ahead, Strengthening Early Warning Signals in Banking. It's a privilege to hold you all here as we unpack one of the most critical capabilities shaping the resilience, agility of today's financial institutions. In an environment where uncertainty has become the norm, the ability to detect early signals of stress or opportunity is no longer an option. It has become now a strategic necessity. This brings together diverse perspectives to explore how banks can leverage the data, technology, and human insights to identify risks sooner, respond faster, and sustain confidence across the markets. Our discussion here in today will look beyond traditional indicators to examine how fast-looking, forward-looking analytics, governance frameworks that needs to be put in place, and collaborative ecosystems that can enhance early warning systems. That's what we are looking for, so that we are agile and quick to respond. The goal is not only to protect the value, but to enable proactive, informed decision-making that keeps institutions ahead of emerging challenges. I encourage everyone here to engage actively, ask questions, share experiences, and contribute to this important dialogue. Together, we can strengthen our collective understanding of what it takes to stay ahead in a fast-evolving financial landscape. Thank you once again for joining us. We all appreciate. I will take this, the honor of inviting our panelists. By quick introduction, we have Daniel Thogo, who is our manager in our advisory KPMG Africa practice, and Amitava. Welcome, Amitava, all the way from KPMG India, partner FRM. Daniel, I will hand it over to you, and then you can hand it over to Amitava. Most welcome to you all.
Thank you very much, Rono, for that kind introduction. And good afternoon once again, our members who are in this particular call. It's good to have you this afternoon. We had scheduled to have this particular webinar tomorrow, but it's a holiday, so we are honored that you have been able to join us at this particular moment. It has been a walk this week. We began on Monday, Tuesday, and we have been really discussing so many things. And it's a privilege that we are here this afternoon to wrap up this particular series. And then at the end of the day, we hope to look back and see what is that one information one learning point that we have taken from this one. But more importantly is that how then are we going to discuss about the early warning signals? And then how does it interlink with all the discussions that we have had? Please feel free to ask any question. And I know this is a very interesting area because talking about early warning signals, we'll be cutting across diverse areas. We'll be talking across governance, like what Abraham has mentioned. And they'll be seeing in terms of the systems and the tools that are there, and what are the feedback and the challenges. And I know we are not the experts. You are the experts because you're the practitioners out there. We have been in this financial sector all along. And without taking further much ado, I'll just take 15 or so minutes to have just an overview of what these particular early warning indicators are. And let us begin by grounding ourselves and understanding what we mean by the early warning signals. And I know there could be different definitions out there, but in its simplest form, and possibly maybe you can engage us and tell us maybe your views on this one, is that an AWS framework is a structured, data-driven system. And what it does, it enables a financial institution to do three things. One, it enables it to detect. And then after it detects, it does monitoring. And then after that, it responds to those particular risks. And even it responds even to emerging risks that with your human judgment, you could not have been able to see it. And one thing that we have been running through this particular week are two things: data, and technology. Where we are heading in terms of the governance, in terms of the banking experiences, how then can we be able to ensure there is resilience of these particular financial institutions that we have been given the mandate to discharge the various duties in our functions. So data and technology is not being left behind. And therefore, we're going to see how then is the integration of that particular data. So you're saying that the early warning system gives you that particular proactive radar. How are you able to convert such particular data? And you're even calling them subtle data that very small things, but they give you a lot of information. They give you patterns. And these particular patterns, you can be able to convert them into actionable intelligence, allowing the banks to intervene early, even rather than reacting. And you will be able to understand from the financial crisis of 2008, we were able now to move even from IAS 39 for those people who are familiar. And we had a very lengthy discussion on Monday about IFRS 9 and its automation. And we are looking forward-looking at any point in time. So when you're talking about the early warning system, or even early warning indicators, or even early warning signals, what essentially do we mean? And as you are seeing in this particular slide, we are saying, then how do we reimagine? Is it in terms of the, is it in terms of the governor? Is it in terms of the people? How do we reimagine? And we are saying that the first important thing is that it is the reduction of the delinquencies. Because if you look in the credit, and of course we have kept talking about credit in this particular webinars for the whole of this week, is that credit risk becomes one of the single biggest risks an institution can ever face. But we are saying that when you book a loan today, when a customer comes in that particular branch, and you have given that customer a loan, do you keep quiet, waiting for the customer to continue paying? And then the only time that you realize things are bad is when that particular customer has failed to pay the installment, or even when the loan has become delinquent. So how then can we change this? Imagine you have given some of the top corporates in the top 50 borrowers to some of our institutions. You find that we have given somebody a loan, or even a corporate a loan, 4 billion, 5 billion. It's an entire group. It's even constituting, almost 25% of our core capital. But how do we monitor? How do we continually monitor to find out whether are there signs, are there red flags that we should be concerned, and how do we manage that particular engagement? So one of the benefits in terms of reimagining and having a more better and effective early warning indicators or early warning system is to be able to reduce the number of loans that goes into default by, through product, through business units, even at portfolio level. And how do we do that? We do that by doing two things. Is that traditionally, we were just, finding that a loan has non-performed once a customer has, missed the payment. So we didn't have any predictive triggers. We were just using lagging indicators, how many days past due. But as long as we want to create more value, and yesterday we were talking about the risk-adjusted return on capital, as long as we as institutions want to continue creating value for our shareholders, we have always to ensure that we are staying ahead. And we have the benefit, as we're speaking, we have the benefit of data. As you are speaking here today in the morning about modernizing lending, we're talking how then we can be able even to integrate AI, artificial intelligence system, machine learning. We cannot be able to miss this in terms of pricing the risk and even identifying those particular risks. So we are seeing that once you're able to identify these, you're able to stop stress early, you're able to even assist the customer, you're going to have an effective SWOT analysis. And in short, we are saying that you are turning the credit monitoring into a forward-looking exercise. That is number one. Number two, we're saying that for us to reimagine this particular AWS, you are having the ability or even the opportunity to design an effective corrective action plan, and even to update your credit policies. And I imagine that, when you have a customer today, and maybe it's a manufacturing firm, they have come, they have taken a loan, they have given you very good financial statements in the covenant that you have said that, we can recall this loan, or we can vary the interest if you are breaching this particular covenant. But most of the time it happens that when that particular customer comes and gets the money, we keep the file. We do not take the file as long as the customer is servicing the loan. But then, how do we develop an effective correction plan? Is that we do not want to go into recovery immediately. We want to continue engaging. Maybe the customer is suffering from management issues. Maybe the customer is highly leveraged. They're having a lot of debt. The liabilities are growing, but we don't know as an institution. How can we be able to have a system that once we feed those financial statements, quarterly financial statements, half-year financial statements, annual financial statements, we feed them into our programs, into our systems, and they can be able to tell us a story, give us insights, patterns, and then we can be able to get into another corrective action plan. And then that is what I've mentioned in terms of identification of trends and opportunities in the market. And you're saying that, by continuously analyzing the internal, of course, and external data, banks can actually be able to, spot positive market shift and rebalance even their portfolios. Because you're saying that if you look at FRS 9, the way we have been doing our PDs, we have been doing that collective assessment. How then can we be able to be accurate enough that the PDs that we are determining per portfolio are accurate? And even how do we use even those particular PDs to justify the pricing of the loans in that particular category? And remember here, and these are the discussions we have been having this week for those people who have been, been able to be with us, that as you're speaking right now, the regulators are having a say in how banks then price their loans. And banks make money by giving money out to people. So even now the regulators, and we are finding this is a posture that is being taken across the East African region. If they are dictating how then you're going to price a loan, how can you do that blindly? How can you price a loan today and you want to be guaranteed that even when it comes to the next 2 or 3 months, that particular risk have captured it very well? You need to have an ability that you're not blindsided, that it is real time, and you're able to factor in all those risks. Like in the morning, it was very unique. We are talking about alternative data. We as financial institutions, only what we have been using even to price our loans has only been the financial statements or even the CRB credit cost. How can we use other alternative data that a customer can be able to give us, behavioral data and all that? And lastly, we are talking about optimizing our capital requirement. We keep on saying this. If you're able to detect risk, you can be able to price that particular risk. You can be able to have the controls and the mitigations in place. If you can be able to do that, you can be able to price that particular customer well, and you can be guaranteed in terms of how you're computing your return, your RAROC, the risk-adjusted return on capital, and you can be guaranteed as an institution, you will always be able to create value for your stakeholders. But then we're asking ourselves, if you look at the process, and don't look at all these particular graphics, it looks like an IT system. And I know some of you, you may not be IT gurus, but this is just a simple process. And what we want to do is that we want to look at, where do you look? And what are the key attributes of a good EWS process? We are saying is that this particular dashboard, it shows a continuous process that converts raw data, the data that you have been able to collect from a customer, into foresight, into proactive interventions. So you're saying, sorry. So you're saying that if you have an existing customer, and you in the head office, you go and tell your branch manager, go to that particular client. And actually, this is the practical problem, because I have been a regulator at one point in time. I've been in the banking sector at one point in time. And what would happen is that you would want to say that I want to evaluate this customer after 1 year, how they are performing. You'd go and tell the branch manager, go and get for me from that customer, go and get the license, whether they have paid the license to the municipal authorities, Go and get the financial statement, go and get, the stock, the stock that they took by, any audits that they have done. And then when that particular data comes, some of it is scanned in files, in PDFs, others in Excel. And then you give the analysts, they are overwhelmed. That data never gets analyzed by anyone. But you're saying we have intelligent systems. Their system, their tools, that once that information goes, even if it is a PDF, just like the way you are applying for a job. And you see now sites are very intelligent. They tell you upload the CV, and then it populates with all the fields, and it can be able to capture those particular metrics from your CV. It is the very same when you're talking about this data that you're collecting from customers. Can you be able to upload those PDF into a system, collect and harvest that particular data, and use it to draw insights as quickly as possible in a continuous way? So then we're asking ourselves, in this particular process, is that it integrates data in these particular 6 steps that you are seeing there. It integrates the data analytics, validation, decisioning, and of course, the seamless loop that you're going to find. Quickly, as I take the next 5 minutes, it's for us to be able to appreciate what this particular process it talks about. If you look at the step 1, you're talking about portfolio segmentation. Here we are saying where to look, because of course you have to begin from the norms. Where do you have to look? And the starting point is that this particular framework is a segmentation. We are saying that your portfolios must be segmented to reflect common risks at any point in time, so that you can be able to know the risk characteristics. And for example, we are saying you can be able to classify, maybe possibly by sector, by product, by geography. And here by geography, I don't know whether like in a bank, are there predominantly those people in a particular region that don't pay loans? I don't know whether you would be biased to assume that. But in the morning, we are being reminded that there is a group of people, and especially, I hope there are no Gen Zs in the call, but if a Gen Z today buys a Subaru and they are less than 25 years, the insurance industry will be very hesitant to give an insurance cover to that person, possibly due to the characteristics in terms of what risks come out with that particular segmentation. So businesses are also able to segment that. So you're saying that for us to be able to have an effective EWS process, you have to be able to create those segmentation. Or even you are doing that as a borrower type, are they corporate, SME, and retail? And I know these classifications are there. And you're saying that this segmentation ensures that customers, they have those EWS model, because you want to create a model. And from that particular model, you are saying, out of there, I've classified these particular loans by sector, by customer. I will have triggers in this particular. What are the triggers? Because the trigger for loans in this particular product would not be the same for triggers for loans in this particular product. The triggers for overdrafts are not the same as triggers for LCs. Possibly have given LCs, and then a country like Russia or maybe Ukraine, they get into war. It possibly may not be the same kind of trigger for a loan that I have given here across in Tanzania and Uganda. So segmentation becomes very important. And you're saying, without it, even the best models will give you noise instead of insights. And I don't think that we'll be here doing all the modeling, even in your institution, just to get noise. Very important. And then the other one, you're talking about data source analysis. And you're talking about building the information nerve system. And how do you do this? You come up with data that you can be able to access internally. Other data you can be able to access, externally. And it gives you a holistic view of the borrower. And then the internal data you're talking about, loan repayment patterns, the account conduct, overdraft usage. External, you're talking about, macroeconomic indicators, the CRB scores, and all those things. And then you're saying that the important here is that data quality, and here it's very important as you're getting this data, the data quality determines the kind of the signal you're going to get. What kind of a signal are you going to get? You say that garbage in, garbage out. Your system can only be as good as the data quality that you're getting. And of course, garbage will give you false alarm. If you look at number 3, we're talking about the early warning signal triggers. We are saying that we are detecting patterns of the deterioration We are saying that for those particular internal triggers, you find that the account changes in conduct. And some of these places is here, the fintechs. Sometimes if they want to know whether you'll still pay their loan or whether to start tracking you, is that when they call you and you don't pick, or even they hear that you blocked them, they escalate the mechanism. So even internally, you'll be able to find that there are those behavioral flags. A customer who was even paying the loan very well, the customer starts, breaching the limits. The relationship officers, when they go there, those people, they are harsh. You can't be able to come up with all this particular data and be able to quantify and put those particular metrics, external triggers, like I've mentioned. And then you're having that the other important aspect is testing. And here we are saying that you're ensuring model reliability. You're saying that, we say that no AWS model is useful until it is validated. And you're saying here in terms of like back testing, you're saying that you're going to go back using historical data and see that if they would have correctly identified past defaults. For example, you go and you say that we're in 2025, and I'll go as at December 2024, and I'll go and find out what were the NPLs. And you would want to simulate back and find, had I gone back as at January of that particular year and done ABCD, will this particular model have predicted the same? You will find that some of the models would have given you a totally different figure. But then when you do that back testing, you want to evaluate, is your model giving you the correct figures? And if it is not, then what calibration, what changes do you want to change so that it can give you very much close feedback that you want? But the key important thing here in terms of the testing is identifying the key metrics. And here I would consider 3 important metrics here when you're doing the testing. You want to find out, for example, the trigger rate. That if I have fed all this particular data and I want to detect what are the kind of the early warning indicators that I want to find out from my portfolio or from the particular customer that I'm testing. For example, I can be able to say how many accounts have been flagged, as through an alert. Possibly I also want to find out maybe the hit rate, that how many of those particular alerts turned out into actual defaults. This is a metric that first of all I'm finding how many accounts have been triggered, how many alerts have been flagged by the system. And then out of those that have been flagged, how many were actual hits, how many actually turned out into actual defaults. But of course, the other one, and it false positives. How often does our model cry wolf? You hear of the proverbial boy that would always cry that there is a wild animal, yet they are lying. For how often does your model keep lying to you? How often does it cry wolf? So those would be very good insights to ensure that our model is catching real risk and specifically, of course, avoiding the things that we see, their noise. Then, of course, the second last one you're talking about scoring. And here in terms of the scoring, you're talking about quantifying the risk. Of course, there are going to be a lot of algorithms that have been put there, others, simple algorithms, others calling them the neutral networks. Those are the mechanics of that particular. But what you're saying is that at this particular scoring, there is a defined metric of then how you classify your borrowers. Are they high? Are they medium? Or are they low? And once you define that this particular customer is a high customer, then you'd want to continue even maybe calling them and saying that, hey, we agreed that you keep this particular covenant, that you say that you not go to borrow loans from any other particular bank because you're going to affect the leverage ratio, even the level of debt to other as an entity. So this is a covenant that you have breached and your risk has increased. So we'll price your loan differently. So this is something that you're doing even before a loan becomes delinquent. And here, one of the challenges that institutions have had when they are doing their IFRS 9, and for those people who know about the staging in terms of how you classify the buckets in IFRS 9, we are saying that from stage 1, it is when the loan is okay, and these are the ECL for the 12 months. But they say that for the loan to move to bucket 2 is when there is significant increase in credit risk. But institutions, and this is the practice, and we have, the feedback we have got in the industry, institutions are not able to move loans objectively to that particular stage 2, because how then can they be able to mention or even identify there is a significant increase in credit risk? They only use the DPDs which is essentially IS-39. So this is a particular critical area to even ensure banks are able to operationalize the IFRS 9. And finally, we are talking about the remediation plan. If an account has been classified as high, we go to a detailed enhancement. You're doing an enhanced monitoring. If an account possibly is medium risk, we are doing tighter controls, covenant reviews, so that at least it doesn't go to a high or even to a non-performing. And then you're saying that if it is a low risk, then that particular account, we can continue monitoring and even possibly cross-sell or even increase exposure. We can say that you are a good customer, you are a less risky person, we will increase the amount of funding. So that is the EWS process. And how then do we think that the 6 steps that we have mentioned, to transform the EWS from simply a compliance exercise into a strategic risk intelligence? Because there, what you have described, those particular 6 steps, that is a risk intelligence engine. That what we are saying, it is creating a full loop from segmentation to detection to analytics and to action. And you're saying that the result for that is actually a living system that learns, with the machine learning, with the AI. It adapts, it strengthens, of course, even the institution's resilience over time. And that has been the message this week. How can financial institutions be able to increase their resilience and create value for the shareholders, both in terms of capital and even in terms of their liquidity and the cash flows? So this is just what I have mentioned here, and this is my last slide. And we are saying that the EWS framework provides the institutional backbone, like I have described there. And we're saying that this is a structure that actually keeps the EWS process consistent. It has to be auditable. And I know some of you are auditors here. These are the things that you go and ask. Give me the policy document for this particular framework. You're saying that, what are the key pillars? And I just want to mention that this particular framework rests on 3 pillars. One is governance. Then the second one is statistical and the processes. Of course, then you're talking about the automation, because you will not be able to do this particular intelligence, to have that kind of an intelligence model, if you're not able to automate this one. But then the key important one is the governance. You can have a good model, but of course we say that you can have a good model, but without governance, then it is like you don't have a model. Because what happens is that when things are good, everybody takes the ownership, but when things are bad, nobody takes ownership. Because you're saying governance is very important because it ensures ownership, consistency, and of course, even escalation discipline. And then when you're talking about the statistical parameters, we are talking about what are the rules that you're going to put in that particular framework. What actually, are we creating a trigger library? The kind of the scripts that you're going to develop in terms of the threshold, in terms of the limits. This is where even we come now, even we put even the risk appetite. We are operationalizing things that have been seen over the time as hypothetical. Like you are discussing these on Tuesday. Like when you're talking about the risk appetite, that the board sits in a board meeting every quarter. And then they're very passionate and they say, we as the board members of this institution, we have zero appetite for non-compliance. Then they say our appetite for the non-performing loans can only go as high as 10%. That is quantitative. Then if you're looking like things like the money laundering, financial crimes, they go and they say, we have zero appetite for these things. But that is a statement. How then do we quantify it? We as a technocrats, we as the people who are running these particular models, into numbers and into specifics that can actually be able to tell a story. And then the last pillar in that particular is that the automation of solutions. And I would want to emphasize here is that digitizing these particular models, it gives them the scalability. And the era we are living in is that we are living in the era of information. Data is available, but how best to use that particular data is not what creates the difference. The competitive advantage, the speed with which we do produce our reports, even service our customers, it's dependent on the data and the system that you're having. And you're talking about in terms of the data load, we are automating the extraction from core banking systems. Can our models be able to have APIs that are fetching directly from our core banking or even from our databases? Can they be able even to be fetching, from the CRBs? Can they be able to fetch from, external databases? Do you have people here who are saying that I would want to go and connect my systems, like with the KPLC data? I don't want to say that even in other places, if you default like even on rent, that data still goes in terms of how it is pricing you. How then can you be able to use this alternative data to do this? Of course, you're talking about data quality, the rules engine, and of course, the corrective action modules in these odds. So as I finish here, so that I can invite Amitava, I'm saying, the AWS framework institutionalizes early detection and proactive responses. The proactive forward-looking is a key here. And you're saying that with this particular framework, governance, statistical, and even that automation, it ensures that data, governance, and technology all converge into one goal. And what is that particular goal? It's to protect, create value, preserve capital, and of course, empower smart lending decisions. So the question is, the data that you're having and the opportunities for us to be able to create this intelligence model, are they there? And how can we be able to solve them? As KPMG, we have had various opportunities engaging with the market, a lot of feedback, even with the other stakeholders, the regulators, and we have been able to come out. And one of the things that drives us is what kind of solutions then do we have to be able to assist our clients, to be able to assist our stakeholders, to do those things, to create value, to preserve capital, and to ensure that they are being empowered in every area, in every decision that they are making. So, Amitava, I take this opportunity to welcome you. And of course, you can give us, one or two experience that are there that you have been able to identify, and the kind of the solution that you have to really address the kind of the intelligence system that we are seeking that the market can actually benefit from. Amitava, please take over.
Sure. Thank you. Thank you, Daniel. Good afternoon, all of you. Happy to be part of this discussion and share some of our experiences of having implemented EWS solution in multiple client offices. One of the reasons of doing automation is that it helps to do all the routine work automatically onto the system, and there is no dependency on any particular resource or people to generate some of these models. Typically, as Daniel was mentioning, data is becoming an important role to play going forward. So we work with the IT department of each and every bank to ensure that we create a sort of data mart, ensure that the data is getting collected, aggregated, data quality checks have been done regularly, so that you can then use the data for more meaningful purposes. Yeah. So moving on to the next slide and just continuing where Daniel left. So what are the key benefits which we have seen when we implement EWS? And this is from our real life experiences after implementing for more than 30 banks across the globe. We have seen that the predictive models, the predictive power of these models increase over a period of time. We have heard a lot of questions that, I don't have enough data. How do I start with? I don't think models will help me to implement. It is still very judgmental. It is very subjective. The answer is there has to be a starting point. It can be today. And over a period of time, having used this system, having used the models, it improves over a period of time. So at some point of time, we have to give it a start, be it a small start or a medium start or a big start, but somewhere we have to start. And hence, over a period of time, we improve the calibration power of the models so that they are able to predict potential default accounts much, much earlier. What we have seen in other markets is that banks use this as a strategic tool. Why? Because one particular customer can have exposures to 5 banks. Now, whichever bank is the first to identify that this account is going bad, he will take a corrective action before the other banks get to know. When the other bank gets to know it's already a default, 90 days have passed and they are still struggling with the exposure. But certain banks who are using data, who are using these models, they are able to identify which account can go bad in the next 6 to 12 months and take corrective action before other competitive banks are doing it. So that's the good part of this particular solution. Of course, it will help you to reduce net losses. It is also important that when you say net losses, it will reduce your capital charge, it will reduce your ECL. We have seen that in most of the cases, a lot of these losses, potential losses have got reduced. As I mentioned, it will reduce your capital cost. With those accounts where more risk-weighted assets are supposed to be kept, you don't have to maintain that, so your capital is becoming more efficient. And of course, it's a learning lesson. Each and every account, each and every default potential bad accounts will help you to identify how I can improve my overall risk management practices. So these are some of the strong benefits which we have actually realized for our clients for where we have done the implementation. Yeah, move next to the next slide. Yeah, so overview of a solution, what does this automated platform does? Basically, having worked across various jurisdictions, we have created a library of alerts. These alerts can be used for various types of portfolio, be it a wholesale portfolio, a retail portfolio, consumer lending, or an MFI. These alerts are some alerts which are being used globally by a lot of banks. We will make available these alerts to you. We will work with you to see what data can be required for these alerts, what data is available, what data we need to collect, and then accordingly we create this entire solution. So the alerts will be provided to you. Whichever you want to use, you can increase or add more alerts to it. Second, you can do a backtesting of the models so that you are able to improve the predictive power of the models. Third, there are a lot of models which can be provided. So as Daniel mentioned, there are certain decision tree, logistic regression models, and we will develop these models for you. So when I say these models, basically, when we implement the tool, we just don't implement the tool. We work with you to focus on the data. We ensure that the data is collected, data quality checks are done. We ensure that the relevant models are created. We ensure that the relevant alerts are informed to you. We identify the sources of data, and then accordingly we configure the particular system. Then various user rules can be created from the front end of the system. So you don't have dependency on KPMG. You can give access rights to various users, relationship managers, collection agents, business heads, so that they are able to monitor the state of the monitoring process. And you can do it from the front end of the system. Dashboarding and reporting, a lot of trend analysis, data visualizations, which relationship manager is doing what accounts are going bad, how I'm monitoring the tool. All these things can be created in the solution. So all those dashboards are made available to you. And lastly, escalation workflow. So in case any accounts are potentially going bad and you're not getting response from the relationship manager, it will start escalating it to one level up after a certain period of days. So that you are able to focus in case any alerts get triggered. It definitely calls for investigation. It definitely asks as to how you are able to resolve these alerts. So definitely there has to be escalation level in the system so that losses of the bank are reduced for the future. Next slide. Yeah. So maybe at this point of time, I'll just share my screen and I'll take you through the automated solution. And then we can get into the question answer round. Yeah, if anybody can confirm you are able to see my screen.
Yes, we can see your screen.
Right. Okay. Thank you. So basically, the solution is a web-based solution. The rationale of selecting a web-based solutions are many. First and foremost, different users can access the system from their own desktop and laptops. You don't have to install any program. You don't have to run any application. This system will be installed on the bank's premises. So the data confidentiality will be maintained. Neither KPMG nor any third-party provider will have access to the solution and the data. So the complete data is safe and within the bank. The system will be implemented on your cloud or on your server, whichever you want to select. We will provide the link to your intranet. Anybody who is using intranet of the bank or any web browser then can quickly get into the solution using your own Windows username and password. So that is as easy as that. Second is the reason of doing it at a low code, no code manner is that the cost of running the solutions is kept minimal. One is that you don't have to spend additional money on hardware, increasing your hardware, investing on additional software, licenses, nothing. You don't have to pay a single penny. The only money which you pay is to KPMG, and we will ensure that the system is running onto your server. Third is that there is no limitation in terms of number of users. The amount of licenses or users, there is no limitation. 500 people can use, 5,000 people can use. You don't have to pay a single money to KPMG. And fourth, which is also very important, that entire workflow is developed into the solution. It is very flexible and scalable. Through APIs, we can link this solution to various sources of data. We can do a lot of searching of data from the intranet so that we can create those alerts. We can link it to your CBS, to your LOS, to your LMS, so that data can be fetched from your database and various systems, and then can be fed into the system on a seamless manner without any manual intervention. So these are the some reasons why which CBS selected a web-based application. I will just log into the solution using my own username password. As I mentioned, the first and foremost, you'll get to see the different dashboards in terms of like what are the counts of borrowers which are in EWS status. For example, here you can see the red status are increasing over a period of time. The greens are reducing. That means that your credit risk management needs to be made more stronger, because the number of reds are increasing. But nonetheless, what is the EWS status? You get to know the count and the percentages, which are the triggers which created these red signals, like bouncing of high value checks, rates by tax authorities, tax returns not filed by the company, by the customer. There are negative news sentiments. There is a resignation of key management personnel, auditors' resignation, whatever can be the triggers. It will tell you that which triggers are creating maximum number of alerts within your bank. So you get to know a trend of issues which the companies are facing. And then we have the resolution of alerts, like how many alerts got triggered and how many got resolved or solved. That became an important part in terms of understanding whether your credit risk mitigation standards and practices are strong enough to resolve the red alerts. And then, of course, there are a lot of more graphs which we have developed for our clients. I'm just showing you one of the instances of a client. When we sit with you, we explain to you what are the best practices, what are the different range of graphs which are available for you. You can select, and then we can customize you for your particular usage. Then I go to my configuration matrix. Here you can see, I can link the various client accounts to my business heads. Who is the relationship manager? Who is the credit head? Who is the regional head? Who is the zonal head, business head? Why I'm doing? Because if any of these accounts get triggered by a red factor, then the relevant relationship manager will be informed automatically by the system. An email alert will go automatically to him or her saying that, look, you are the relationship manager of ABC, and there is an incident happening in ABC. Please quickly go and talk to the client and come back with your feedback. So that type of mapping can be done into the system so that automated email alerts can be triggered. You can create a library of alerts within the system. What are the different types of libraries which are available? You can add additional libraries into the system so that you are able to monitor your portfolio. Then you can come to the EWS models. When I say EWS models, we will help you to calibrate those models. These can be simple models, expert judgment models, or statistical models. And when I say models, it can be a single parameter or it can be a combination of parameters. And how do we do this? Exactly what Daniel explained to you, that we will take a cutoff point. For example, today is October 2025. We go back to October 2024 and see that, okay, over the period of next 12 months, which are the accounts which had defaulted, which are the customers which got defaulted. And then we start analyzing that what have been the triggers that eventually ended up in a default. So once we understand those nature of accounts, what are the issues which the accounts are facing, we apply those natures to my current condition as of October 2025 and tell that, look, if some of these incidents happen in October 2026, which are the accounts which can potentially become default. So we try to understand the behavior of customers. We try to understand what can be the criteria or parameters which we need to monitor so that we are able to predict these defaults. So these are models which you will create for you. And of course, there are additional models which you can yourself create from the front end of the system. Then we come to EWS indicator, where we see that what are the different types of segments. So we can create a different types of segments for you. It can be an industry-wide, it can be a group exposure, it can be city-wise, it can be a zone-wise. Those types of segments can be created so that we are able to enhance the predictive power of these models. So that we will be creating for you. And then finally, once the triggers and the models are created, and an external data comes to the external and internal data. So there can be a lot of behavioral data. For example, there are, the average credits have reduced over the last 6 months. Number of debits has increased over the last 6 months. The account is always overdraft for the last 3 months. There are some, unknown transactions happening in these accounts. So there can be various transactional information. There can be various external information. For example, auditor's resignation, income tax rate, resignation of key management personnel. There are some frauds which has been reported, fire in the factory, whatever. Climate reasons can also be a reason. So those can be some of the external reasons which we will capture, and then we'll combine external and internal. And based on that, we will identify, okay, what accounts can potentially show some issues. For example, in front of you, we have a customer called Coal India Limited, where we see that, okay, most of the factors in this particular account are green in nature. So this is a good account. I don't have any worries, so I can continue with this account. However, there are certain accounts down where they are showing a lot of red signals. For example, Hindustan Petroleum, we all know because of Trump, there's oil prices are on the boil. There are a lot of issues, macroeconomic issues India is facing. And we are being told not to buy oil from Russia. We have to buy it from US. So, a lot of chaos is happening. And what is happening out of all these geopolitical issues, macroeconomic issues? Some of the accounts are getting impacted. So we can see out here that this account has got impacted because there are 3 red triggers. Similarly, there are some other accounts where there are more triggers. So we get to know, okay, these are the accounts where there can be a potential problem. What happens is, once the red trigger is created, it typically goes to that particular relationship manager. And the relationship manager is then informed in terms of like what created these triggers, right? For example, we can see for this account, there was an IT raid in the system, okay? And then there is a tax default, which the company has also done. And there are certain recent resignations in the management team. So what the relationship manager will do, he will get an alert that, look, this account, there is 3 red triggers. He will now go and talk to the account and will have specific facts to talk. He's not talking in the air. He will say, look, you had an IT raid. What happened in that raid? What was the outcome of the raid? What did the IT authorities find it out? You also defaulted in the latest tax filings. Why did it happen? What happened triggered to that? Did you rectify it? Did you pay the final taxes? There we have also heard that your MD has resigned. Why did he resign? What are the reasons? So he can do those further discussions based on facts, and he can update the system saying that, look, these are the reasons why we believe that this trigger had got created. There can be false alerts, and that means that you can close the ticket, but there can be genuine alerts. If it is a genuine alert, in the system, you can identify what are the mitigation steps. For example, you may say that, look, we want to reduce your credit limit, or we want to increase your interest rate, or if we want to have additional collateral call, or in extreme cases, I want to close the relationship with you. So in those types of discussions, you can always do with the account, and accordingly, you can update the system so that, the system is updated that you have resolved some of these issues. So this is how the system works. It's very easy to use, very simple user interface. We will develop the data, we will create the alerts, we will create the models for you. We will monitor how the alerts are getting created over a period of 6 months, 7 months, 12 months. And then it's a continuous improvement process. more importantly, it will create a high level of awareness within the business team that these are the areas where they need to be mindful of their accounts or the relationships, and this is how they can monitor these their relationships in a more stronger fashion. So the entire dashboard, the entire workflow has been created into the system, and we will be able to quickly install it on your premises, and then we can then see how customizations can be done so that you are able to monitor this on a continuous basis. Okay, so back to the slides, maybe. Can we have the slide up? Yep. Daniel, maybe back to you to pick it up.
Thank you very much, Amitava, for for that demo that you've given us. Indeed, it was it was intended that by the end of this particular week, we would be able to be wrapping up, because essentially what you've been able to conclude and to be able to bring into perspective is that at the end of the day, we may be having very good systems, but if you're not able to leverage on the data that we are having and to be able to have those particular insights on terms of the red flags, those particular warning indicators, it would not be doing enough justice, even especially to the institutions that have given us a particular responsibility. And we as we are coming up to the close of this particular session, and even before we proceed, and I would want to continue inviting people who have questions in the forum to do so. And I usually have a poll that we usually take. So I would also request that you be able to give us your views and your feedback. But before that, there are three things I want to mention in terms of what then is a call to action. Even after going through all that, what is a call to action? Three things in that perspective. One is to ensure that we modernize our early warning signals framework. And if you are here, you are the head of risk. If you are here, you are the head of compliance in the institution that you are in. If you are here, you are in the first line, either in the second line, or even in the third line, you are providing assurance. It is very important that the strategy of any institution, and of course, we are talking about the strategic risk, is that if you do not have this particular early warning frameworks, you will not be able to ensure that you have been able to control those particular risks effectively. So what we are saying is that you shift from manual, ratio-based monitoring to data-driven insights from the data that you are having. And what we are saying is that let your insight be data-driven, let them be predictive, let them be automated. And you're saying that these particular systems, when they integrate, you're going to be finding the discussion that we are having here this week, where we are talking that ICAP has been like a hypothetical document, where it is just an academic document, just a tick box to the regulator. You find that this document and these particular processes develop meaning, integrate with the IFRS 9, the pricing models, all of them come back together. And then the second one, invest in data analytics and infrastructure. And what you're saying is that you will be able to strengthen your internal and even external data pipelines. Of course, you're saying that you're going to have those interlinkage into your core banking, CRBs, macro data, and all that. And then the third one, and this is what we are here, and we are saying that you embed this particular early warning EWS into the strategy. Because if you're doing all these and it is not speaking to your strategy, then you'll be doing yourself a disservice. So you're saying that these particular insights with respect to portfolio management, capital optimization, strategic planning, all of them achieve one thing that we have been talking about. You're achieving resilience and stability. So what you are saying in terms of how then can we be able to help as KPMG? in terms of what you have been able to demonstrate there. And these are journeys you've been able to work with our stakeholders all over in Africa, even in India and even other places. We have been able to design and implement these modern EWS frameworks. And what you are saying is that it is the development from end to end, in terms of the governance, in terms of the triggers, the scoring models and dashboards, all of them tailored to each bank's portfolio in the regulatory context. And what you are saying here is that institutions, most of the time, they're not starting from scratch. They have these particular systems. But the problem is they're working in silos. So then how do we do this? We automate. That is the second thing. How then can we be able to help automate and integrate with the CRS platform that you're having? That is the GRC platform. That is the governance and risk platforms that you're having. So once you do that, you're able to monitor, you're able to score better, you're able even to improve even your reporting. Even if it is about those delinquent loans, you're able to escalate them properly. And of course, what you're doing is that you're enabling portfolio monitoring through this particular intelligence. And finally, we're talking about enhancing capability. And Lisa, you can be able to, put the poll up so that people can actually be able to give these insights even as we conclude. We are saying that some of the areas that you find is that the bank has the systems, it has the data, but then the capability is what is the challenge. Then how then does, do we help by this, providing training, things that even we call playbooks. This is where at least you go and, you're looking at, the things that you need to do and tick the boxes. You're doing a self-evaluation to ensure that EWS becomes effective and becomes part of the daily decision making. So as I conclude, I would want to, look back and reflect the whole week, and even for those people who have been here with us, is that this week we have really learned from Monday, IFRS 9 automation, and looked at ICAP and ILAP integration. Yesterday you looked at the risk, adjusted return on capital. You're talking about, driving, the principles of how we are driving our pricing. Yesterday morning we talked about lending modernization. And now that we have talked about early warning systems, one message stands out clear. And that particular message is that risk management, as we speak, is no longer about protection. It is about prediction. So, we talk about how then we mitigate, how we measure, how we identify, we measure, and then we control and all that. But they're saying that we are no longer talking about protection anymore. We are talking about prediction. How well you can be able to predict your risks. And predicting accurately affects a number of things in terms of your pricing, your capital, and all that. So you say that institutions that will thrive are those that can convert data into foresight, and foresight into action, and action into value. And so you're saying that this is a new frontier. And as we are wrapping up our weekend reflecting on what you're talking about, resilience institutions, you're saying that where, that is where finance, risk, technology all converge to create, smarter, faster, and even more resilient banking systems. So let's keep this particular conversation going, keep collaborating, keep pushing boundaries of what's possible, because the future of risk is already here. And it's intelligent. The risk is intelligent. So I want to give back to Ron, so that at least you can be able to, talk to our participant and your parting shot, even as we come to the end of this particular webinar. Back to you, Ron.
Thanks a lot, Daniel. I think I can see there's already the solution poll. We appreciate your response on that as we continue to leverage and use data to make meaningful decisions within our organization. And just a word of to thank you all for your time and thoughtful engagement this afternoon. Our discussion on this topic, strengthening early warning signals in banking, has been both insightful and timely, because the earlier you seize an opportunity and take advantage of the EWS, the better for any organization for data decision making and driving decisions. Also, we have explored how the sector can move from being reactive to predictive through the data analysis now, from monitoring the risk to anticipating them, and from isolated responses to actually integrating the resilience. When I was listening throughout the conversation for Amitava and Daniel, a few key themes stood out. First, the need to blend data-driven intelligence with sound judgment, showcasing the technology that Amitava took us through. That being technology is always an enabler. But remember, behind any technology, human insight remains irreplaceable. The second point that I picked throughout is the importance of cross-functional collaboration. That means when you look at the strong early warning system, it requires alignment across the different facets within an organization, across the credit, risk, finance, and the operation side. And the third, but not last, the shift from the compliance-based reporting to a strategic foresight. And this early warning will actually assist not just as a risk management tool, but as a competitive advantage. So it actually gives us more competitive advantage across the sector. As we conclude, let us carry forward the challenge to continually enhance our early warning frameworks, strengthen data capabilities, and cultivate the right culture of vigilance and agility within our institutions. On behalf of the organizing committee, I sincerely thank our panelists, Mitava, Daniel, and participants for depth of insights and open exchange shared today. Your contributions remind us that foresight and preparedness remain the strongest pillar of banking resilience. Thank you once again, and also to appreciate the whole organizing committee for the back assistance that has happened, the slides preparation and everything. And thank you once again. And I wish you all a productive rest of the day and the long weekend ahead. Have a good day.
Thank you. Thank you, all of you. Have a good, restful weekend.
Thank you. Love you. And have a blessed holiday tomorrow.